Yahoo Finance's Brian Cheung is joining us now. He spoke with World Bank President David Malpass earlier this morning. Brian, what did he tell you about the World Bank's response to this crisis?
Well, Julie, the World Bank's primary function right now, especially with the COVID-19 crisis, is trying to broker agreements between debtors and their creditors in terms of how, especially some of the poorest countries in the world, will be able to meet their debt obligations. Now, one question, though, is how can you try to lower the debt stock in a time when countries need to spend to support the economy? Here's that conversation with David Malpass, again, the president of the World Bank, from earlier this morning.
That's been the trade-off that we've wanted to emphasize to the G20 and to the commercial creditors as well, that if they take payment from the poorest countries, that means less money in the country for food for children. You know, you can, it really is that dramatic. And so we need to have everyone participating in this. The World Bank does it by very strong net positive flows. So for the countries, we're putting in huge amounts of new money that helps. But if that money just ends up being paid to creditors, that undercuts the value of it. So we're trying to work together with the international community to allow more resources to be available to the countries themselves as they fight COVID, but also the education crisis. And that means the need for a lot of resources, but also importantly, it means the need for new investment. Let's say next year you were considering investing in a country that's currently in debt distress. You'd be very reluctant because those delayed payments to all these creditors kick in either next year or in 2022. And so it makes it hard for you as a new investor to invest in the countries. So I think we've got to get to a reduction in the stock of debt. That will be the most valuable freeing up of resources that we can do.
So I want to shift gears. You mentioned China earlier. Politically speaking, there's been a lot of flaring tensions between the United States and China. And it's calmed down recently, but there was some chatter on Capitol Hill, even if briefly, about the idea of refusing to pay China on U.S. debt that they might hold. From your vantage point at the World Bank, especially with the escalation of tensions, do you worry about the weaponization of debt, maybe not just in the U.S., but around the world?
China over the years, you know, this has come up of will the U.S. pay China on the debt that China holds? And I think that part of the system is very stable. If you look at the relationships on finance, they've been strong. So when you say weaponization of debt, I don't think that's the best term. A better way to think about it, I think, is to think of debt as leverage in a country, and especially in the poorer countries, the heavily indebted countries. So one of the things we're trying to do right now in July and August is make sure that the debt that central banks offer to other central banks is properly accounted for. If it has the character of debt, then it should be counted as debt, because otherwise what you end up with is multiple leverage on a country, on the developing country, to have the central bank repay the other central bank, and that gives political leverage. An example of that, Mongolia has had a relationship with China through the central banks that is, which I think, more properly characterized as a debtor-creditor relationship. If that can be transparent, transparency is very important in this, because then people can look at it and understand what's going on. Interest being paid from Mongolia to China on debt that's held by the central banks. And so then people can think about the role of that in the relationship between the two countries.
So you mentioned central bank actions, and I think it'd be interesting to also put into context the Federal Reserve's actions in providing U.S. dollar liquidity globally. But what's been interesting to see is the dynamic of the dollar itself. One impact of this crisis has been a weaker dollar. I believe the dollar index is at about a 93 handle. If you're one of those emerging markets with a heavy reliance on exports, and you're watching the buying power of the world's largest reserve currency going down, what are the effects of that?
In the past, dollar weakness has been okay for the developing countries. Some of them are exporters, and so they can benefit from the higher dollar price of their exports. And some of them have some degree of fixed rate debt, so as in dollars, so that as the dollar weakens, that benefits the repayment stream. And so I think the bigger question is not so much about the dollar itself, but will new FDI flows, foreign direct investment flows, restart to the developing world? What's been happening so far, this inequality problem is gigantic because it's both within countries, but it's across borders, and it's particularly apparent the advanced economies are recovering earlier, and the stimulus measures are aimed at benefiting the people of those countries, and there just is not a mechanism right now for it to benefit the poorer countries. We need to find that. I think that we know what the mechanism needs to be, but it's not there yet, and that's the new investment by the global savers into the poor countries, recognizing that they have huge upside potential.
Here, we touched on a number of topics in that discussion. We talked about China specifically as a debtor to the United States, but then also by extension in a previous part of that interview, China to other nations around the world, the World Bank trying to work with the Paris Club, which is an informal group of creditor nations around the world to try to broker negotiations among those poorer countries who are really struggling to make ends meet during this COVID-19 disruption. But broadly speaking, you can hear what David Malpass said in that last response there. He said the inequality problem is gigantic. Not everyone, like the United States, can afford to spend $2 trillion to support their economies during this time, which means that the ultimate outcome of this crisis at a global scale is going to be a widening gap between the richest countries and the poorest countries. Julie?
Unfortunate as it may be. Brian Cheung, thank you so much. You can view that entire interview on yahoofinance.com.